Bismillahirrahmanirrahim. In this short presentation, I will briefly outline the basic approach to risk management from the Islamic perspective and identify issues and challenges related to risk management in Islamic banks. The broad perspective on risk and risk management are embodied in the overall goals of Islamic law or Maqasid al-Sharia. The principle of Maqasid would imply taking all the precautions to safeguard present and future wealth. As a risk in economics represents the probable loss of wealth, it is not desirable in itself from Islamic perspective. However, while the risks are not desirable on their own, they must be undertaken to create wealth and value. The risk can be divided into three types from Islamic perspective. The first is the business risk, that is the essential risk inherent in all business transactions. This risk is necessary and must be undertaken to earn the associated reward or profit. Two legal maxims are relevant here. The first maxim states liability is an obligation that accompanies gain. This maxim attaches the entitlement of gain to the responsibility of loss. This maxim is usually used to propose the preference for profit and loss sharing financing instruments. The second maxim is derived from the prophetic saying, the right to profit from something goes with liability for it. The maxim asserts that the party enjoying the full benefit of an asset or object should bear the risk of ownership. For instance, the implication for a sale-based transaction is that the seller must bear all the risk associated with the object of the sale, and in a leasing contract, the lessor should be responsible for the asset leased out. The second risk is the prohibited risk in the form of excessive gharar. Gharar is usually translated as uncertainty, risk, or hazard. Generally, gharar relates to ambiguity and or ignorance either regarding the terms of the contract or its object, while a minor gharar is tolerated. Presence of excessive gharar invalidates a contract. The third and final form of risk is the permissible risk that does not fall in the previous two categories. Examples of this risk can be operational risk, liquidity risk, etc. This risk can either be accepted or avoided. Now, let's look at the risk faced by Islamic banks. There are two types: risk similar to those faced by conventional banks and risk that are unique to them due to their compliance with the Sharia rules and principles. One such risk is Sharia non-compliance risk. As most depositors and investors use the Islamic banks due to their Islamic character, these banks must ensure that all their activities conform to the principles and values of Islam. This would require contracts and all necessary supporting documentations, including the legal papers, forms, and processes to be Sharia compliant. Now, let us look at some of the risks inherent in the Islamic modes of financing, particularly financial risk on the asset side of the statement of financial position. Let us first look at murabaha, which is frequently used by Islamic banks. Here, the risk may arise in two stages. At the beginning of transition, where the banks buy asset based on a promise from the buyer. If the promise is not binding, the Islamic banks may get stuck with the asset and be exposed to market risk, as the price of the asset can change adversely when it is being disposed. Furthermore, any loss arising from damage of the asset before delivery to the buyer will be borne by the bank. To eliminate the market risk, the Islamic banks usually make the promise binding on the buyer. During the transition period, once the goods are delivered to the buyer, the payment of the price is due in the future, and the Islamic banks face a credit risk. To reduce this risk, the banks can ask for guarantees and collateral in case the debtor defaults on payments. In case of delinquency, the banks can opt to foreclose on the collateral or go to court but may not increase the outstanding debt. Now let us look at another popular contract in Islamic banking, which is mudaraba. Here, at the beginning of transition, Islamic banks face the risk of adverse selection, which means selecting a non-viable client or business venture. This risk arises due to the bank's lack of competencies in project evaluation. During the transition period, the Islamic banks face the counterparty risk due to the problem of information asymmetry, which is expected to be high under mudaraba. The counterparty risk includes misreporting of profit by the manager. In conclusion, there is a prophetic saying that states that tie the camel and then entrust it to Allah. Accordingly, the Islamic approach to risk management is to understand and control the causes of risk and then leave the final outcome to the will of Allah. Hence, the Islamic banks should have a comprehensive risk management system to identify, measure, monitor, report, and control the various risks faced by them. Although the Islamic banks are constrained from using some of the risk mitigation instruments used by their conventional counterparts, as these are prohibited under the Islamic commercial law, in reality, Islamic banks frequently take up the risk management techniques that transfer risk from bank to client, which mimics the conventional banks. This trend dilutes the uniqueness of Islamic banks and blurs the differences of the two systems. This remains as a challenge for the Islamic banks due to operating in a dual banking system. With that, thank you. Ma'as salama.